well, we're going to start today with our conversation with Ben Mathias of Vertex Ventures. Ben, welcome to the session.
Thank you, Samana, and thank you for having me here.
So, Ben, let's start by introducing you to our audience. Some background about yourself, some background about Vertex Ventures. What size funds? What is the focus?
Yeah, my background is I became a VC about 11 years ago, and before that I was actually a tech guy working in Silicon Valley in the enterprise software industry. I moved to India about 10 years ago to start VC investing here. Joined Vertex 3 years ago, and just a little bit of background on Vertex. We are a global network of funds headquartered out of Singapore, and we have active funds in the US. We have one in China, we have one in Israel, and I'm a part of the Southeast Asia and India fund. We're an early stage tech-focused fund, typically invest in Series A, sometimes Series B, and our initial check size is just like typical Series A investors, between $2 and $5 million. And then, of course, we reserve money for follow-ons.
How big is the fund?
Broadly, the Southeast Asia and India fund is $210 million.
Okay.
And our current fund, we closed late last year, and so we're about a third into the investing cycle of that fund.
Okay. So just FYI, we had your Israel partner here recently as well, so we've heard from the Israel perspective.
I know, I saw that.
So what sectors do you like to focus on?
We've done a variety of software investments, both in Southeast Asia as well as in India. I'll give you some of the recent examples. We invested in a company called Active AI, which is a software for conversational banking. A company that originated out of both Singapore and India, but now is pretty much selling globally, including in North America. We also invested in a company called Flutura, which is industrial IoT analytics. Again, that's a company that originated in Bangalore, but is now deployed in several large oil and gas companies in the US and in Europe. So we look at all types of software, enterprise SaaS, IoT, AI, a lot of fintech software as well.
So B2B though, mostly?
No, I wouldn't say that. Our fund, we've done both B2B and B2C. We have a very strong B2C portfolio as well. For example, we were the first investor in Grab, which is the ride-sharing leader in Southeast Asia. We also are investors in M17, which is the largest video streaming, one of the largest video streaming companies in Asia. And then First Cry, which is the largest mom and kid e-commerce company out of India. So we've done a lot of B2C. I'd say a lot of our recent investments have been in B2B and in fintech across Southeast Asia and India.
Let's spend a few minutes talking about geography. You're talking about Southeast Asia. What is the boundary of where you like to invest? And then I'd like to also understand configuration. We obviously cover India very extensively, and as you know, we have a big presence in India. So we have come to observe a bunch of trends that I'd like to discuss with you in terms of configurations of companies. So why don't you start and I'll probe.
Yeah, in terms of geography, Samana, we are a Southeast Asia and India-focused fund. So other than India, we also invest in companies in Singapore, Indonesia, Malaysia, and we are looking at opportunities in Thailand and Vietnam as well. From an India standpoint, we invest in companies that focus on India as a market, and we also invest in companies that originate in India but focus on global markets. And a lot of those companies tend to evolve into being cross-border companies, typically one founder in India and one in the US. And in some cases, they even shift their incorporation to the US. And a lot of the operations remain in India.
And So would it be fair to say that your consumer investment is in the markets that you're in, like the Indian market or the South Asian market, Southeast Asian market, whereas the B2B investment is global?
That's correct. So consumer investments, typically if it's a company that originated in India, it stays focused on the Indian market because that is a very large market, as you know. If it's a company that originated in Southeast Asia, for example, in Singapore or Indonesia, they tend to expand across the region, and they eventually expand to all the Southeast Asian economies. So Grab, for example, is now in most of the Southeast Asian countries. So,
do you invest in
B2B
ventures that would be Indian B2B facing, for instance, Indian SMB, Indian B2B?
We do, and in fact, most of our companies started off as being as having their initial customer base in India. But at the end of the day, the Indian market, B2B market, is limited in size, and you could probably get to be a $20 million ARR company if you're focused on India. But if you really want to get to the $100 million ARR, you need to be focused outside of India as well. And we find sort of two categories of companies. There are the companies that have built solutions for emerging markets, and they would typically expand out of India into Southeast Asia and the Middle East. And there are companies that have built technology that are applicable in global markets. And then the quickest path to success there is to be able to start penetrating the U.S. market. But all these companies all originated in India. Their first set of customers were Indian customers, and those customers helped them hone the software and really fine-tune it before they start taking it overseas.
What, if you look at the deal flow from the last 12, let's say 15 months, what are the highlights? What trends are you seeing?
Yeah, it's interesting. The deal flow has really changed in the last couple of years. So 2 years ago, we saw a lot of deal flow in consumer companies, B2C companies. We saw a lot of deal flow in the shared economy, for example, shared ride-sharing, logistics sharing, those kinds of things. Now, that sector has sort of, I would say, matured beyond Series A, and the clear leaders have emerged in those sectors, and those leaders are now raising B rounds and C rounds. What we're seeing a lot of now are sort of two categories. One is fintech. We still see a lot of early-stage fintech companies, and then we see a lot of enterprise SaaS in the Series A, and typically companies that have raised $500,000 in seed funding and have gotten to close to $1 million in revenue, and then are ready to raise their Series A. And then we're starting to see a lot of pure-play tech companies, AI, NLP, IoT. The challenge there, of course, is to sort through all the fluff and really sift out the companies who are doing genuine technology development rather than just using the buzzwords to impress the VCs. The good news is that we started to see a lot of pure-play tech companies in the last 1 year.
Can you elaborate on some fintech concepts that are promising in the current Indian landscape or Southeast Asian landscape?
Yeah, so fintech, we're seeing a lot of different things within fintech. So one of the big areas that we're seeing a lot of is in digital lending, both for SMEs as well as for consumers. And the success of Aadhaar and UPI and also the eKYC norms that have been rolled up by the government are lending themselves very well to digital lending. And so we've seen a number of companies there. We've also seen a lot of companies in personal finance, so wealth management, investing strategies for middle-income people. Typically, the higher-income people get one-on-one personal finance help, but people who are 25, 30 years of age who are in IT jobs, they don't have a solution available. So we're seeing a lot of companies app-based solutions addressing that. The other thing we're seeing a lot of is supply chain financing, so businesses to finance their receivables. And this is across both India as well as Southeast Asia. The one thing we're seeing in fintech, the trends are fairly similar across the region, and we're able to sort of learn from various companies in different geographies because of very similar trends.
And what is your assessment of the regulatory situation around all this?
Well, I think the regulatory situation has definitely come a long way in the last few years, and definitely with UPI and eKYC norms that have come out, it is a lot clearer in terms of regulation. One thing that we're still waiting to evolve is P2P lending, the regulations for P2P lending in India. But beyond that, I think the regulations are quite clear on digital lending in the country.
The peer-to-peer is not yet in swing.
Peer-to-peer is not yet very clear. RBI has issued some guidelines, but I think the reason VCs have not jumped into that space is because the regulations are still not very clearly defined.
But all other forms of digital lending, there's no real regulatory hurdle in building companies. It's more execution hurdle.
No.
Okay.
Yeah.
Good.
Yeah. There's no regulatory hurdle for the other forms.
And in terms of deep technology companies, could you share maybe one or two examples from your portfolio or from your radar that are interesting, global potential, projects?
Yeah, let me talk a little bit about one of the companies I mentioned a few minutes ago, Active.ai. This is a technology company that's building technology solutions for conversational banking. And they are deployed with several large banks in India. They're deployed in one bank that's across Southeast Asia and also one in North America, being used in multiple languages. And the use case here is basically for people to do their banking either through a chat interface or through a voice interface. This could be transactional banking. This could be something as simple as QAs, FAQs, but different customers have deployed it in different ways. And when the company first came to us at their seed stage a couple of years ago, we were not quite sure whether this thing would actually get adopted. But we've been very excited by the fact that several large banks have actually adopted this and have gone live and are using this in production. And this is technology that got built in India, but is now being used in North America. It's being used in several countries in Asia. And we're very excited about this company.
And what is the funding cycle of this company? Where, how did the company build its technology? What stage did it start raising money? Where has it raised money, so forth?
Yeah, so it raised money, I think the first round was about 2 years ago. The company, first of all, got started in the 3 founders, 2 in Singapore, 1 in Bangalore. It raised the seed round about 2 years ago. And then we started talking to them maybe middle of last year for the Series A. And in, I think, October, November, we closed the Series A round. We led the round. The seed investors, which were IDG and Kalari, co-invested with us. And then we also got a couple of other investors to come in for about $1 million each. So this is about an $8 million Series A that we led.
And that's the only fund financing they have so far?
That's correct, yeah. So they've done the seed and they've done the Series A.
And for a company like that to get to Series A of the style that you're talking about, what are the metrics? Is there already revenue, significant revenue, $1 million revenue? What are we talking about?
Yeah, they were at about $1 million of revenue before, at the time they started talking to us for the Series A. And really the metric for us was, can this thing be adopted outside India? Because as I mentioned earlier, you can be very successful in India, but only get to be a $20 million business. So number one, is the technology applicable? Are there non-Indian companies that will use this? And number two, are the founders really capable of selling outside India? And we see a lot of companies with great potential, but the founding team doesn't have that experience, that skill set to go into North America and start selling, for example. And this team proved it to us because they sold both in Southeast Asia as well as in India. Sorry, as well as in North America. So those are kind of the two metrics that we looked at. We also did a similar investment in a company called Futura, which is industrial IoT. Very similar situation. When they came to us, they were about $1 million in revenue, and they already had Fortune 500 customers in several countries. And that's what got us convinced.
So it's a reasonably fair statement to say that Series A deals in your geography are happening post-$1 million revenue run rate.
That's correct. And the good thing about starting a company in India is that the costs here for developers are very low, and you can build a company, you can get the product out, and you can get your initial set of customers with under $500,000 of funding. And there are a good number of incubators and accelerators, seed investors in India. So it's a very healthy ecosystem for seed-funded companies right now. And we actually have a problem of plenty because we have a lot of companies coming to us that have reached that $1 million ARR, and all look very attractive. But of course, we can't invest in all of them.
And when you look at the Indian geography, like, within India, what is the distribution of deal flow that you're seeing? Is there a bias towards Bangalore? I know Chennai has done pretty well. Pune has done well. What are you seeing in terms of a more general statistics from your perspective?
Yeah, it's pretty scattered. I'd say about Bangalore for sure is the leader in terms of number of companies, but we do see a lot of companies coming from Chennai, from Pune, and also from the NCR region. And recently we started to see a lot of startups out of Hyderabad as well. So I'd say
all the cities are performing.
Good distribution.
Okay.
Sorry?
All the cities are performing. All the major metros are performing. Yes. What about the Series A gap? You just said that there's a lot of companies that are able to get to $1 million ARR. How much of that pool is getting the Series A funding, and what percentage is falling into the Series A gap?
Yeah, there are probably about 10 to 15 active Series A funds here in India, and I'd say that's just about enough at this point. So I don't think we have a shortage in Series A. And all of us interact quite a bit. We share deals. We co-invest on opportunities. Where there is a gap, I do believe, is in the Series B and Series C. And on the consumer companies, we do get, I'd say there are a lot of Chinese investors that are coming in, investing in the later stage rounds for the consumer companies. But if you're not able to get one of those investors, then you're sort of stuck for the later rounds. And in the enterprise companies, I think to get to Series B, Series C, you really need to start going outside India to find those investors who write the larger checks.
But that's really not a big problem because if these companies are trying to go global, it sounds like most of you are investing in Series A deals that are global B2B. If they have the metrics and with their Series A funding, raising Series B, Series C in Silicon Valley or elsewhere in the U.S. is not that difficult. Are you in agreement with that statement?
That is true, and I think the role of one of the roles that we play is to number one, help the founders get established in North America, and we're finding that they don't necessarily move only to Silicon Valley. We've got some people move to New York,
yes,
and but get them really settled there, get them plugged into a network, get them introduced to advisors, and then of course get them connected to the VC ecosystem. And that sometimes takes 6 months to a year before they can really get settled in, but that gives them enough time before they have to raise their Series B.
Mm-hmm. And what is your analysis of unicorn mania? We've settled down a little bit here in the Valley. I my sense is that in India, the unicorn mania that did happen, I was surprised that it happened to that extent, but it seems to have settled down. How do you parse the happenings of the last 3-4 years?
Yeah, it has settled down here as well, fortunately. Many of the, I don't think we've added to the list of unicorns beyond the initial list that we had a couple of years ago. There are companies that are sort of getting into the multi-$100 million valuation. And the good news is that the companies that are getting there are companies that really have good cash flows, that are stable companies. So we have a company in our portfolio, First Try, that's getting to that range, and they are close to cash flow positive at this point. What has gone away is the mania of companies that are losing millions of dollars every month and are just getting funded for no reason. So I think things have definitely become a lot more sensible right now.
So the bidding war that happens to get to these multi-billion-dollar valuations that created this unicorn mania were kind of driven by a few funds. How has the behavior of those funds changed?
Well, they're still active in India. So, for example, you still see funds like SoftBank, Tencent, Alibaba still writing large checks in India. But I think they are the behavior in the last year has changed, and it's the really high-quality companies that are raising the $100 million plus rounds right now. Another example of a company that just raised a large round is Big Basket, and Big Basket's metrics are very strong, from what I understand.
So the competitive bidding is not happening. Is that to me? How do you check the valuations?
No, the competitive bidding is not happening right now.
I see.
And the other thing is, of course, there isn't a very large pool of investors that are able to write these $100 million plus checks. There's just a handful of them. So I don't think there's need for competitive bidding at this point.
Okay. So my last question is, an observation that we're in 2018. A lot of stuff has already been built. And, relative to the amount of capital that is available in the market, there are, 700 plus micro VCs in the market right now. There's a huge number of entrepreneurs who are starting companies and so on and so forth. We can't expect that every single venture out of this cauldron of creative energy is going to become a billion-dollar company. It's just not mathematically viable. Those are rare, skill sets, or those are rare market opportunities. But there are actually lots of opportunities for building smaller companies. If you're looking at 100 million, 200 million, 300 million TAM, there are lots of niche opportunities in those spaces. And there are some funds that I've talked to who are making note of that, realizing that it's not necessarily as easy to constantly for everybody to chase unicorns, and they are investing in some of these companies with the caveat that they will have to seek early exit. Are you seeing this phenomenon in India? Because you said there is a lot of companies that are getting to $1 million ARR through their seed funding. And my observation is that not all of these companies actually are playing in these billion-dollar markets. You can get to $1 million ARR in a 100 million TAM market or in a $50 million TAM market that would not really qualify for a significant Series A funding because of the TAM issue. What's happening to this pool of companies?
Yeah, I think the companies that reach $1 million and don't get Series A funded, these companies are actually cash flow positive at this point in time. So they can choose to remain at that level and continue to grow, maybe not as fast, but they will grow from, without any additional capital, they will grow to $3, $4, $5 million on their own. But you hit the nail on the head. I think a very good investment model that is very doable in this geography is to build these companies to get to $100 to $200 million in valuation, and then have them get acquired. And to get to that stage, particularly for enterprise companies, you don't need to look beyond a Series B, which means that they don't need to raise more than $15, $20 million of capital. Get to
or a lot less, actually. You know, the bulk of the exits happen in the sub 50 million valuation range. So if you can build a company for, you know, very small amounts of money and sell at the sub $50 million range, that is a decent success for, you know, a set of entrepreneurs and a set of investors, as long as you control the parameters that drive making such an exit successful, that you haven't raised too much money that then it's not an interesting exit, right?
I agree with you. In fact, we've got several companies in our portfolio where we've done the Series A that are at a point where they can be acquired for $50, $100 million. And there have been soft feelers from potential acquirers. So we know that we can sell them if we want to, based on the scale that they've achieved.
What are some examples of spaces, more like the categories in which you're seeing these companies?
So the enterprise companies that I talked about, so the IoT company, the conversational banking company. We also have recently invested in a company that is a SaaS solution for small, medium-sized hotels. They've got 2,000 hotel customers across the world in about 100 countries. There's been soft interest from strategics to either come in or to acquire the company in the future. We've got an investment in a company called SignUp, which has 10,000 SME customers in the U.S., built out of India, 35-member team out of India. And there again, there's been sort of soft feelers from people to look to either come in as strategics or to acquire the company. So we do know that all these companies
you are paying attention to that phenomenon, that there are, you know, not everything is going to be unicorns, but there are smaller exit possibilities as well.
Yes, and our fund economics can be very successful with these $100, $200 million exits.
Mm-hmm. All right, well, very good overview of your activities, as well as a good, you know, trend analysis and back and forth on the Indian and South Asian market. So thank you, Ben, for your perspective. Are you staying for the rest of the session, or do you need to drop off?
I will probably drop off, Shamana, that's okay.
Okay, no problem. Well, thank you for coming today.
Thank you. Thank you so much.